Hello, everyone. Greyson Geiler here with SES Services, giving you a weekly market update for the week of February 19th. Hey, if you like this presentation, smash the like button down there, subscribe to our channel, and forward this to other people that may think would be interested in the presentation. Okay, so our topic today is government spending is red hot, which I'm sure isn't a big surprise to anyone listening today. But when we look at the economy around the world, really, and especially here in America, and the markets, the stock markets, the bond markets, things have been holding together remarkably well over the last few months. So from 20,000 feet, that sounds great, but when you start to dig down and figure out why, at least some of it, maybe a lot of it, is due to how much money the US government is spending. So you can go on to the Treasury website and you are looking at the fiscal year for the US government ends at the end of September. So starting September 30th to now, we've already rung up more than $1 trillion in debt, meaning government has spent more than $1 trillion over the last 4 and change months than it is taken in taxes. That is absurd. That is a huge run rate. That's a run rate of almost 10% of the economy. Well, when you look at the history of these numbers, this is going back to just after Second World War. US government actually used to run a surplus. I know that sounds a little bit crazy. Well, we're normalizing not only deficits, but we're starting to normalize wildly big deficits. And keep in mind, these numbers actually look better than they truly are because these numbers don't include the borrowing from the Social Security surplus that we used to have. So there actually wasn't even a surplus back in the 90s that this chart shows us here. But you see, obviously 2008 was a huge bomb. The economy was in terrible straits. The government spent a lot of money that it did not take in taxes, hence a budget deficit of about 10% of the GDP from 2008. Things started getting better, but we really never got that far. I mean, even at the best of the 2000 teens, we were still running 2.5%, 3%, 4%, almost 5% in budget deficit. Again, meaning the government spending 5% of the GDP more than it took in taxes. Just to put a perspective on this whole chart here, keep in mind when the Eurozone was created in the late 90s, one of the prerequisites to join the European community economically was to not be running more than 3% in budget deficits. Well, that now we are normalizing wildly higher deficits than that. So we've got the COVID right here, of course, and we ran a budget deficit of almost 15% of the GDP, which is outrageous. So now we're starting to roll back over. Look, we don't know exactly what the budget deficit is going to be for 2024, but we're running way hotter than we were last year at this time. And last year we rung up a $2 trillion debt. So what does that mean? Lots of the economic growth that we've seen is on the proverbial credit card. Now, there's a little bit more that makes it even more daunting. I want to show you this chart because this is simply the interest expense that our government is spending on the debt. And again, the debt is over $34 trillion. Well, the math gets pretty easy. The average interest rate that we're paying on that debt, we being the federal government or the taxpayers of America, the average interest rate on that debt is over 3% now. Well, 34 trillion, 3%, that's more than $1 trillion. So just going forward, before any Social Security is spent, before or sent out to people, before we spend any money on the military, before we spend any money on the types of things that the federal government is spending on, we're already obligated to spend $1 trillion, the interest on the debt. So that, that's pretty crazy. Now, when you look at the justification for these things, again, during deficit or during economic recession times, the government's going to spend more money than they take in. That's been normalized. But look where we are now. The economy's running well. The unemployment rate is less than 4%. Stock market's up near all-time highs, and we're on pace to run a 10% budget deficit. And it's an election year. Politicians spend more money in election years. So I'm a little nervous that that's going to continue. Now, more than a little nervous. Now, JP Morgan, one of their analysts, just put out a report because of the reverse repo situation. I don't want to go into the details of exactly what the reverse repo market is, but that is dwindling. The reserves in reverse repo is dwindling. JP Morgan thinks that some of the red hot government spending is going to back off towards the end of the year because of that. Let's hope they're right on that. What can we do? Looking at these numbers, look, this needs to get reined in fast, or this could spiral out of control. Well, as investors, day by day, normal, average, everyday people, what kind of things can we do? Well, we've got a checklist, and we start to sound a little bit like a broken record, but start with this. Just streamline your financial life. It's not just people that are too busy, still working, have kids, running around. It's also some retirees that we see that they're paying a lot for convenience. And what I mean by that is they're paying a lot of bills that are coming due. Maybe they're auto paying them and they don't even realize how much they are. All kinds of things that have changed, and people haven't adjusted their spending for it. Maybe check your insurance, how much you're paying for property casualty, for your car insurance. Check how much you're paying for your phone bill. Check how much you're paying for your cable bill. A lot of people are turning cable off because it's so much cheaper to just go to streaming. There are lots of things like that we can all do just to streamline so that we're not spending more money than we need to. Reallocate your resources, reallocate your investment portfolios. If you're not sleeping at night because you feel like you have too much risk, you need to readjust that. Now, just because crazy stuff is happening and the government's spending more money than they have does not mean the stock market's going to go down. But a lot of what's going on is pretty leveraged up and kind of risky. So maybe it does. The point of the matter is you need to have your stock exposure at a comfortable level. We always advocate to have some money in the stock market, but everybody's situation is different. Lock in higher interest rates where you can, and especially in the portion of your portfolio that you're using for month-to-month expenses or even year over year, or maybe the portion of your portfolio that's IRA and maybe you're getting into your 70s and you have to take required minimum distributions. Perfect part of your portfolio to get into the guaranteed interest rates through maybe it's long-term CDs, maybe it's long-term annuities, just fixed annuities that are interest rates that are guaranteed. Look, these higher interest rates probably aren't going to last very long. I know a lot of people have been saying that, including myself, for a long time now. But that's a good thing to lock in higher interest rates, your guaranteed returns. If those are the assets that you're regularly drawing off of, look, you don't want the assets that you have to draw off of in the stock market, because when you're pulling money out and the market's had a bad few months, it can really decimate your portfolio. Keep your speculative assets to a minimum. Now, anytime we're talking about the challenges that our fiscal and monetary system has, a lot of people bring up the cryptocurrencies, Bitcoin, Ethereum, that sort of thing. That's great we don't do that, but if you have some speculative assets that you want to keep allocated to those, that's great, but make sure it's manageable. Always make sure you have some gold. One thing to understand is gold is money. Gold is not an investment. So everyone should have some. Maybe you want to keep it in your closet. If you do want to keep it in your closet for security, maybe an emergency situation, that's great, but don't compare it to your stock portfolio. Don't compare the performance to your stock portfolio. It's not an investment, it's just money. Now, if you do want to invest that gold into something that you're going to get a return on, you can do that too. First and foremost, it's just money, and everybody needs to have some. Continue to watch videos and get information from a number of different sources, because I can't stress enough there's some wild stuff. There are wild things in the pot, so to speak, that is brewing, from politics to economics to maybe war to all sorts of things going on. Nobody knows exactly how this is going to roll out. So continue to do your homework. There's not going to be a situation this year, at least, where you can sit back, kick back, and think that everything is okay and you've got it all figured out and you don't have to worry. Keep watching videos. Again, if we can help, reach out to us. Our information is here on the screen. Smash the like again, subscribe to our channel, and forward this presentation to people that you might think are interested. Appreciate your time, and we'll see you next time.